Hey, what's up, everybody? It is Thursday, April 7th. Hope you're doing well. So the market rebounded off of the lows today. We had a positive close, but gave back a little bit near the end of the day. Nevertheless, a positive close. There was a posting on Zero Hedge where they apparently were shocked at the amount of consumer credit. Now, if you've been watching my videos, I've been, pounding this home every week when I talk about the bank credit trends that are going on. I said, credit card and revolving credit, that's growing at the fastest pace in 13 years. I mean, I've been talking about this now for a pretty long period of time. I mean, I follow these banking metrics every week. I post them in my report, MMT Trader, and I mention them here on these videos. So that was one of the things I've been talking about as a support, as a pillar to the economy. Obviously fiscal, that's the core thing, but also bank credit, extremely important. And it's been strong, it's been rising. You had consumer loans rising at the fastest pace in 13 years. So yeah, I mean, for Zero Hedge, maybe that's a shocker, but it's not a shocker for anyone who is a subscriber to my report, or even if you're watching these videos, because it's something that I've been talking about. And they also went on to say that savings are long gone, which that's not true at all. We got 1.1 trillion in personal savings. Now that's way down, from the peak, the pandemic peak, the stimulus peak in 2020 when we got up to 6 trillion. That was, I mean, if you see that in a chart, it's just like, it's mind-blowing. That's just like this massive, unprecedented spike, and that was all from the stimulus, which again shows that, the spending by the government adds to the income and the saving of the non-government. And since that spike, some of that has been taken away as a result of a slower rate of fiscal and also taxation. Remember, during the COVID period in 2020, tax filings were suspended. So people got to keep that money. But nevertheless, that 1.1 trillion, even though it's down, massively from the 6 trillion, historically, that's still a very high rate of personal saving. I mean, normally, if you go back, if you look over the period of the last 40 years, it probably fluctuated anywhere from 300 billion to 600 billion, and 600 billion used to be the high level. So 1.1 trillion is still a fair amount of saving. And remember, it's important, I think, to understand as well that saving is a leakage to demand. What's important, at least insofar as the economy is concerned, is the spending. It doesn't necessarily have to be the spending by households or the non-government. It could be the spending by the government. That's what drives, economic activity. So, saving right now, it's not, and the way it was framed in that Zero Hedge article, that savings are long gone, that's just incorrect. That's false. But the important thing now is that bank credit is expanding, and if we're going to talk about bank credit, and here's another thing that I've mentioned many times before, the most important metric is debt service burdens. Like, how hard is it to service that debt? If you're making your monthly payments every month, nobody's going to come after you, and that is the key thing, all right? And right now, debt service burdens are very, very low. They're way down from the peak we saw in 2007, when I think they were up almost about 14% of disposable income. That's the burden every month that it took to service that debt. You're talking about mortgage debt, insurance, all your payments, credit cards, stuff like that. And now it's down to around 9%. That's up a little bit from the all-time low, which I think was 8%. But historically, it's still way down. So debt service burdens, the difficulty of servicing that debt is not very high. Now, that's going to go up when rates go up. But again, I don't see that, at least in the near term, as anything that we need to worry about. I mean, if it got back up to levels that we saw in 2007, that might be a problem. The other thing I think that it's important to focus on, because a lot of people are talking about, they're making comparisons with prior periods which were pre-pandemic. Government was spending 4.7 trillion. So here's what I'm saying. They're talking about this, the quantitative tightening, the QT, the rate hikes, okay? And they're talking about the last time the Fed did QT, which ended in 2018. Remember, they started reducing their balance sheet in 2000, I believe it was in 2016 or 2017, and they kept that going all the way through the early part of 2019, when they actually, and I spoke about this, when they actually reduced reserve balances below the minimum threshold that the Fed requires. I mean, the Fed actually brought bank reserves down below its mandatory threshold for the banking system. So it literally put the banks in non-compliance to, the Fed's own regulations. But that's a whole different story. I spoke about that on a previous video. What I'm saying is that the folks now who are comparing the 2018 QT and saying, oh, look what happened, the market dropped 20%. And the market's down off of its highs now, but I mean, what they're missing is that in 2018, fiscal was 4.7 trillion annually. Fiscal right now is 7.7 or 7 maybe this year will come in around 7.2 trillion annually. So I mean, to ignore that, or to not be aware of that, and to try to draw analogies between now and 2018, that's just wrong, because you're leaving out a very important factor, a very important variable that has changed. I mean, you're talking about an additional 3 trillion annually in spending, or 2.5 trillion, let's say. I mean, so, and again, what I've been saying almost every day now is that it's not a tightening. It's a recomposition of assets, of financial assets in the economy. I mean, you're going to have more securities and loans at the banks and less reserve assets. I don't see that as a negative. I mean, I've said this over and over again. We'll see if I'm wrong or if I'm right, when they start doing this. But I do not see it as a negative. I mean, reserve assets, to me, have been a drag on the banks. I mean, they don't earn much. Okay, they clog up bank balance sheets to the point where, there's so much piled on the bank balance sheets, they either need to raise capital, or it impedes their lending ability, or it slows down their ability, impedes their ability to hold other assets that are maybe higher earning assets, like Treasury securities and agencies and MBS. But now you get rid of those reserve assets, and the banks have more room on their balance sheets to hold higher earning assets. What's wrong with that? I mean, it only means they're going to make more profit. And bank stocks have been getting hammered. I mean, I keep buying them on the way down, because I'm looking past this. I'm looking into the future when, they're going to have, I think, a much stronger financial position based on, better assets, better quality of assets. I mean, reserves don't do anything. Excess reserves, they just sit there in the banking system. Maybe banks make a little couple of basis points lending those reserves out overnight to other, banks. But I mean, they're just basically useless. Well, the only thing they really need to have are those required reserves. Excess reserve just sitting there clogging up their balance sheets, and everybody's getting so, crazed about this. They're getting so freaked out about this, and I just find it to be, I don't know, like I've been saying every day now, we'll see what's going to happen, but I'm pretty sure I got this, I'm pretty sure that my understanding of this and what I'm saying is how it's going to play out. I do not see a problem in the Fed reducing reserve assets, and up until this point, and I made many videos on this, I said there is a problem with the Fed dumping reserves on bank balance sheet month after month after month. I mean, this $120 billion a month that they've been doing for 2 years is completely useless, and it's completely counter to what they're trying to achieve, if that is, a support to the economy, or or if they're trying to get, lending going. And, again, Fed is a bank, and they think like bankers, and they're all thinking like, oh, we got to get banks to lend. I mean, look at Europe, right? I mean, it's been their whole thing for years, and yet they keep buying assets, and they're like, banks got to lend. Why aren't they lending? Or in Japan, I mean, the banking system in Japan is basically like a zombie banking system, which exists now just to clear. I think those banks, or most of them, probably insolvent based on the trillions, the quadrillions of yen that the Bank of Japan has pumped onto their balance sheet. I mean, it's completely useless. So we're going to get rid of that burden. And I don't see that as a bad thing. So anyway, let's keep track of bank credit. It's an important factor in the economy, very important factor in the economy. But when you're talking about bank credit, you got to also understand, like I always throw in, what is the burden on debtors? Like, is it at a high level, or is it at a level that is, not that burdensome? And right now I would say it's the latter. It is not a big burden. And so now, when we're about to get into a situation where, we're going to see these reserve assets taken down, that's a good thing. Banks will buy treasuries, they'll buy agency securities, they'll buy MBS, they're going to, create more loans. That is a positive thing. It's not a negative thing. So, I mean, I'm bullish. Anyway, that's it for today, folks. Please like and subscribe, and I'll see you tomorrow. Bye.